Welcome to Daybreak Australia. I'm Heidi Stroud-Watts in Sydney. We're counting down to Asia's major market opens.
I'm Annabelle Droulers in Hong Kong, and the top stories this hour. A cautious start ahead for Asia trade, with investors split on whether stocks can sustain recent advances. The first of 3 Treasury auctions this week drawing solid demand for 3-year notes.
ByteDance filing a US legal challenge to its forced TikTok sale, setting up a battle that could make its way to the Supreme Court.
And Israeli forces edge into Rafah in southern Gaza, even as ceasefire negotiations continue, with a deal proving elusive.
This is what we're watching as we head into the start of trading in about an hour's time for markets including Sydney and in Tokyo. Take a look at the setup here in Australia. We're seeing futures upside of about 0.2% there, so a little bit of a muted start to opening. So a mixed session is really expected. It was a sluggish US session. Really, the market's remaining very much split on whether this is a rally that can sustain the amount of exuberance that we continue to see, given the economic cross currents that we continue to see and the uncertainty over central bank policy. We're seeing a bit of downside when it comes to trading in New Zealand. Chicago Nikkei futures are trading pretty much flat at the moment. We're seeing modest gains in Australia, potentially that drop in Japan, and a steadiness when it comes to the open in Hong Kong. When it comes to FX, we're seeing the Aussie dollar trading at 65.91. The dollar jumped by the most in about a week. The yields situation sort of pairing much of the drop that we saw across the greenback, as we also see that rebound across oil prices. Some of those comments from the Fed Reserve Bank of Minneapolis President Neil Kashkari weighing on trading as well. We're also ahead of the Tokyo Open Bell, really watching for what we're seeing in moves in the yen. We had the BOJ Governor Ueda really saying that he did tell the Prime Minister Kishida that he's carefully watching the impact of these levels for the yen.
Yeah, that's right. Certainly intervention of very big risk or question marks over that. We can perhaps expect a little bit more jawboning as well following those meetings there. But this is the outlook here that we've got for US futures. Again, you can see very steady going in the session, and so it sort of continues that tone we had intraday as well. It has been really that question mark of where exactly do we go from here? You've had good earnings coming through. You've got that prospect for Fed rate cuts that is back on the table for this year. But still, on the flip side, you've got elevated interest rates, this prospect we are still going to be high for longer, and inflation as well, stickier than perhaps expected. So again, traders are really split, investors are split on where we go from here. But JP Morgan is among those saying we could be due a pullback. But on the other hand, you've got the likes of Citi and Bank of America that are now looking at some signals that it could actually be the time to snap up shares here. So that's the state of play, as we said, for US futures. Of course, one of the big aspects of the intraday session as well on Wall Street was just this latest challenge from TikTok as well, because they're suing the US government to block a new law that aims to force its Chinese parent company to divest or face a ban. The move sets up what could be a prolonged court battle pitting free speech rights against national security interests. Bloomberg Political News Director Jody Schneider joins us now from Washington. And Jody, this is the first legal challenge that we've seen since Congress passed the law back in April. But just start us off here with some of the details of it.
Yeah, well, what's happening is that ByteDance, the Chinese-based parent company of TikTok, says it has no intention of selling TikTok. That this is, they say that they've been basically given no due process, that this is not constitutional, and that the U.S. needs to rethink this. What happened was there was legislation passed as part of broad-reaching legislation that funded Ukraine and in Israel, and also included this this part of the legislation that would require the sale of TikTok require its Chinese-based parent to sell it on national security grounds, or it will be banned in the U.S. starting next January. The Biden administration did this on national security concerns. The president signed it after it was passed in a bipartisan way in Congress. So it's really setting up a national security debate against some of these free speech rights. Of course, the Chinese government does not see any reason that they should get involved in this, and they're saying that there's no reason to go ahead and make that sale. So this will, we expect over months, it will go through various court challenges and end up at the U.S. Supreme Court, really pitting those national security concerns against free speech.
Jody, can the app still operate in the US in the meantime? What are the sort of political implications of a ban?
Yeah, so it can operate in the U.S. They're not going to have to go ahead and pass an emergency order or anything to do that. But at the same time, there is real politics involved, because a lot of small businesses and others have come out very much against a TikTok ban, saying this is how they do business now. And of course, many young people kind of live on TikTok these days. And some of these are young voters that the Biden administration will really need for its coalition for his reelection. They've, before this, they were actually advertising on TikTok, using TikTok users as, as a way to get their message out. So there's some real political ramifications if it is banned. Of course, what the Biden administration and Congress had been hoping was for this sale rather than a ban, but ByteDance today made that clear. They're not going to go that route.
And Jody, we've also heard from the former US Treasury Secretary Steven Mnuchin saying that he's still interested in buying the US operations of TikTok and thinks that the technology could actually be replicated too, right? What are some of the conversations happening around this? Or is it kind of a moot point if ByteDance has been pretty clear in its intentions to not sell?
Yeah, I mean, there's that issue, if they're really not going to sell. So, the buyers become a little bit of a moot point. But there is this issue of replicating it. Steven Mnuchin and others have kind of made the point that, well, maybe if they, you can't beat them, you can't join them, beat them. And beating them would be to really be able to replicate this algorithm. Others think that's not so easy. The reason that TikTok has become, so incredibly popular is this algorithm. And remaking this won't be terribly easy, which is why we saw this legislation passed to begin with.
And of course, it's not just TikTok that's in focus in the US, it's just these continuing restrictions or tightening of restrictions on China's access to advanced chip-making equipment as well.
Yeah, so today we saw a move to really further tighten those export restrictions and not allowing Huawei to have access to Qualcomm or Intel's chips any further. And we've seen these restrictions continue, but this was another round of this, according to people familiar with the matter. But then we heard from Michael McCaul, the chairman of the House Foreign Affairs Committee, who confirmed this, who said they're really trying to tighten these restrictions and allow no chips, no American-made chips, to get to Huawei, making it very difficult for them to make this advanced technology.
Bloomberg Political News Director Jody Schneider in Washington with the latest on TikTok and some of those tech cross-currents. Well, President Xi Jinping has arrived in Serbia on the second leg of his European tour, looking to bolster ties with a country that's embracing Chinese trade and investment. His arrival comes 25 years after the deadly US bombing of the Chinese embassy in Belgrade during NATO operations aimed at pushing Yugoslav troops out of Kosovo. In a Serbian newspaper, Xi wrote that China will never forget the attack, which the US blamed on faulty maps. Well, staying with geopolitics, and the US says Israel and Hamas should be able to resolve their differences over a proposed ceasefire in Gaza. That contradicts top Israeli officials who say the two sides remain far apart. Truce talks have stalled as Israeli forces edge closer to the city of Rafah. Meanwhile, President Biden has condemned the rise of anti-Semitism as part of a ceremony to remember victims of the Holocaust.
That hatred was brought to life on October 7th in 2023. On the sacred Jewish holiday, the terrorist group Hamas unleashed the deadliest day of the Jewish people. I have not forgotten, nor have you.
For more, let's bring Bloomberg editor Michael Heath with the latest. And there's sort of optimism. Is it sort of based on anything?
Look, it's important to sort of get the timeline here right, Heidi. So the Israelis started to move into Rafah, sent these warnings to Palestinians who were there that they need to move, and suddenly Hamas had agreed to the truce with that happening. So Israel is definitely on one hand pushing, trying to exert pressure on the on Hamas to do this deal to release the hostages, but it's also setting itself up to try to complete its operation as well. So Hamas is under a lot of pressure, but Israel is going to be under a good deal of pressure as well, because the US definitely wants this. I mean, as we've reported, that Prime Minister Netanyahu is aware that President Biden does not want a war going on, protests on universities, etc., while he's trying to run a re-election campaign. It just doesn't work for him. So the Israelis are almost running a two-track thing here, trying to pressure Hamas to do a deal and release the hostages, but also setting themselves up to complete the operation. And a poll shows that most Israelis want those hostages released. They think it's more important than going into Rafah. So, look, the Israelis say they're quite far away, but the Israelis are also playing their own game there. The US seems fairly confident that something could happen. So, really, given the state of Hamas, I mean, if it doesn't agree to this and Israel proceeds, potentially that's the end of the organisation, or at least it'll be decimated. So it is in their interest to try to get a deal done.
What is the standing of Hamas, though, now? Because one of the big question marks is over all of this has just been how much further radicalised people could be, and it would be incredibly difficult to stamp out.
That's exactly right, Annabelle. I mean, Hamas's popularity, whenever they've done polls or tried to do polls in Gaza, but certainly in the West Bank where there's less fighting, obviously it's sporadic, but it's not a full operation, Hamas's popularity is very, very high, and the Palestinian Authority, which is sort of the inheritor of the old PLO, is in single digits. So Hamas is seen as the representative of the Palestinian people, not necessarily as my understanding goes, that because people support what it does, but it's the only group that's sort of offering resistance. Now, I mean, we're almost at famine, or if not in famine now in Gaza. I mean, there's another generation or two now who will be radicalised, and this is why it's so critical about, you know, having some sort of plan for what happens after this war, which Israel has been very definite in trying to avoid. But the potential for radicalisation is very high, and the ability to stamp out Hamas. I mean, you go into Rafah, presumably a certain number of fighters or leadership melt away as well. You know, this is a devastated sort of area, and we've seen in other areas where Israel has bombed or has cleared militants that they pop up again later. And so Hamas is still going. I mean, you know, it fired rockets and killed some Israeli soldiers on the weekend. I mean, it still is a viable group, and it has its political leadership outside. And if not Hamas, then something else will morph as well, because until the underlying issue is solved, resistance will continue. And, you know, people are living in a Stalingrad-style environment down there now. I mean, there's very, very little hope there. So it's really, really worrying about what the future looks like.
There are huge implications for regional players too, right? In terms of Egypt, the risk of both humanitarian overflow but also militants crossing the border as well. How important is that relationship for Israel?
Look, it's hugely important. I mean, Egypt was obviously the first country to recognise Israel and to sign a deal with them in 1979. And Egypt does have problems with militants in the Sinai Peninsula, which is where the Palestinians would need to evacuate to. It's been very clear it does not want refugees, that these people have a home. It is Gaza, and they shouldn't be going there. And Egypt, at certain points, has gone so far as to say if Israel, you know, doesn't do its best to protect civilians, to ensure they're not pushed out, it would reconsider that agreement, which is, you know, it's a really, really big red line, that one. It would have devastating implications if that was to be reversed. But yeah, look, Israel is highly aware of that. They know how important Egypt is. Egypt is very important to the US as well. So what Israel has done now is it's actually taken control of that border crossing just in its little campaign that it's done to try and stop the movement of weapons. But it will be very mindful of Egypt's position. Qatar, similarly, both Qatar, Egypt and the US, they're the ones that are really, really pressing this deal.
Bloomberg editor Michael Heath there with the latest, and you can get that roundup of the stories you need to know to get your day going in today's edition of Daybreak. Terminal subscribers can find that at Daybreak Go. It's also available on the mobile in the Bloomberg Anywhere app. You can customise those settings as well, so you just get the news on the industries and assets that you care about. This is Bloomberg. Minneapolis Fed President Neil Kashkari thinks it's likely the US central bank will hold rates until officials are confident inflation is under control. Speaking with Bloomberg TV at the Milken Institute Global Conference, Kashkari said the Fed will do what's needed to hit its 2% target.
The second half of 2023 surprised us at how rapidly inflation fell. That was really good news, and the economy remained strong. We all hoped that was going to continue. The first quarter of this year, it seems like it's stalled out. So it's a little too soon to declare that we're definitely stalled out, or maybe it's just taking more time. I think we're in a good place right now. Labor market is still strong. We can take our time to get more data to see if disinflation is going to continue. And if it does, great. If it doesn't, then we need to take that on board.
What is the complexion right now of disinflation? What actually drove us, at least down to the level where we're at right now?
Most of the gains that we saw last year were supply side improvements. Supply chains getting better, Americans coming back to work, a lot more workers entering the labor force. That's really positive. I don't think monetary policy actually brought demand down that much. And so most of the gains were because of the supply side. Now the question is, if monetary policy has to take us the rest of the way there, is it tight enough to do that? I wrote an essay today on our website raising that question. And I'm not sure how tight monetary policy is. We need more data to assess it.
How do we know that the disinflationary process has still some ways to go? Or how do we know that maybe this is it? This is the new normal?
Well, it's not the new normal because it's 3%, and the Fed can and will achieve 2%. The question is, if disinflation is still underway, then maybe it'll continue on its own, and we can then take that on board. If we need to hold rates where they are for an extended period of time to tap the brakes on the economy, or if we even needed to raise, we would do what we need to do to get inflation back down.
I have to just ask you, though, about 2%. And I know why the Fed stands by that 2%. But I talked to people around the room this week here, and their cost of capital, they're basing that more on closer to a 3% rate. And the idea is they're saying, look, the 2% target, that needs to come up. That's not the reality long-term structurally, at least not for the folks in this room.
Yeah, I disagree with that.
Yeah.
I mean, I think that ultimately the central bank, whether it's the Fed or the ECB or the Bank of England, can determine whatever the inflation rate is. And over time, if they conduct their policy appropriately, people will come to understand that, will adjust their behavior. We're committed to 2%. We will get to 2%, and we will get an interest rate environment necessary in order to achieve 2%.
That was Minneapolis Fed President Neil Kashkari. They're speaking with our colleagues Carol Massa and Romaine Bostic. Let's bring our next guest, Gary Schlossberg, who's a global strategist at Wells Fargo Investment Institute. In a lot of ways, it makes complete sense, right? The Fed is likely to stay higher for longer until there's absolute confidence that inflation is under control. What do you think that potentially looks like, given that we do see that gap still between monetary and fiscal policy and the distortions that continues to create within inflation prints? And are markets at this point kind of, seeing the reality of that situation yet?
Well, I think longer term, there are some headwinds out there. We're running large budget deficits. There is a tendency for them to move a bit higher. Near term, though, we are beginning to see the economy soften. We think the recent economic data do continue to point toward a mild, maybe a moderate economic slowdown during the latter part of the year that should take some additional pressure off inflation, at least for a time. The big question is what happens after that? As the economy recovers, what is that equilibrium inflation rate? And how hard does the Fed have to try to bring that inflation rate down to a more acceptable level?
In the meantime, what does that mean for the sort of style of trading that we've seen really dominate, right? Are we going to see more pressure when it comes to rate-sensitive sectors, given that earnings, by and large, have been pretty favourable for tech?
Well, we think the good news has been that tailwind provided by earnings. The real concern was the upside risk to interest rates, which we think is dissipating now that there are signs that economic growth is winding down. I'm referring to the employment report and the Purchasing Managers Survey for services activity, the dominant sector of the economy that came out last Friday. That, along with other evidence, suggests that growth is losing momentum, and that should take the pressure off interest rates. We think the market can navigate that fine line between slowing earnings growth, no recession, and interest rates coming off a bit more, and that allowing valuation, accommodating higher valuations.
So if growth is slowing down, where are you looking to put your money instead? And that includes, of course, markets outside the US, possibly.
Well, we have advocated quality all along for the last couple of years. We think in this kind of economic environment, quality becomes most important. That means large cap over small and mid-sized stocks, the U.S. market, over developed markets, over emerging markets. Sectors that we favor, healthcare being one of the more defensive sectors of the market, benefiting from favorable demographics. And we also favor materials, at least for now, and industrials, more for secular reasons. The commodity supercycle underpinning raw materials, and industrials benefiting from fiscal stimulus and a variety of other factors benefiting that sector. We are positioned to rotate, but we think it's a little too early for that, given the uncertainties out there.
So with that sort of backdrop in mind, would you be more bullish or more likely to put money to work in China or in Japan?
We'd be reluctant at this point. China does have a few things going for it. We are seeing export-led growth. How durable, how strong that will continue to be remains to be seen, given some of the headwinds out there. Likewise for Japan, the depreciation of the yen, much like the yuan, is creating a more favorable export environment. But up against the U.S., in this kind of environment, with the focus on quality stocks, we just feel more comfortable with a bit of a bias toward the U.S. market.
All right, that US exceptionalism persists. That was Gary Schlossberg there, global strategist at Wells Fargo Investment Institute. Thanks so much for your insights. We'll have more to come on Daybreak Australia. This is Bloomberg. Alrighty, taking a look at how US futures are faring so far in the session. Look, not really seeing too much action this morning so far, but it does really tell that story to us about what happened intraday as well. Traders are just very uncertain on what's to come from here. You've had strong earnings, you've got that prospect for Fed rate cuts, but at the same time, interest rates are still elevated, inflation is still sticky, and investors as well coming up with some quite different calls. You've got the likes of JP Morgan, for instance, saying that we're due for a pullback, but Citi and Bank of America are looking at signals that now could be the time to snap up shares. That's the outlook for US futures. Let's switch now and take a look at what we're expecting in South Korea later this morning. We've actually got the trading debut. We've got the trading debut of a big company in South Korea, HD Hyundai Marine Solution. That's a ship repair company, raised more than or nearly $550 million in its IPO. Price at the top of the range, strong demand. Investors saying we could see a bit of a pop, only a very small amount of the company expected to start trading later today.
I think the most likely scenario is where we are right now, which is just we stay put for an extended period of time until we get clarity on, is disinflation in fact continuing or has it in fact stalled out? I don't think we know the answer to that, so I would say the most likely scenario is we sit here for an extended period of time.
Minneapolis Fed President Neil Kashkari, they're speaking at the Milken Institute Global Conference in Beverly Hills. Take a look at the setup. It's looking pretty mixed as we get into the start of trading. We're about half an hour away from the start of cash trading here in Sydney. About 0.2% indicated upside there for futures after we had a pretty mixed kind of set of messaging. Interesting messaging from the RBA, despite, of course, staying on hold as expected at 4.35% in the meeting yesterday. Kiwi stocks are already seeing a little bit of downside there. there. Nikkei futures looking pretty muted, looking like we'll see a negative start to the session there as well. We did hear from BOJ Governor Ueda saying that he had communicated how carefully they're watching levels in the yen to Prime Minister Kishida as well. So that weaker currency, you know, when it comes to the benefit that we have for exporters, it used to reliably boost shares of car makers, for example, in Japan, inflating the value of their sales and profits overseas. But it's interesting that that correlation between the yen and stock prices has actually broken down. Our senior Asia stock reporter Hiri Kusano joins us to explain why. And Hiri, really great to have you here in Sydney. So, you know, what's interesting, because you've long said currency is only kind of a small factor when it comes to the rally, but we've actually seen that correlation decrease for the car makers.
Yeah, I mean, it's very interesting because, I mean, car maker is probably the most, has the most benefit from a cheaper yen. No other sector has benefited from a cheaper yen than car makers. But even these car maker shares have started to underperform when the yen has declined. So that could be possibly a sign that things might be changing. Now, since around mid-March or April, Japanese car maker shares have underperformed the broader Japanese stock market as well as other competitors in other countries. So many investors are starting to feel that something might be changing in the dynamics of the market at the moment.
As that sort of benefit for car makers comes to an end, are we kind of entering a period of stability for the yen after the excitement of the most likely bouts of intervention, or do we expect that divergence to continue to play out?
That's a good question. I mean, I think it's still too early to call. I mean, I see different views from market players, but many long-term investors do think that there's a risk that the yen might rebound in the future, given that the yen has been so cheap. If you look at the purchasing power parity, the yen should be around 95, whereas at the moment the yen is 160. So if you think that over the long term the currency might correct to levels where prices, where the price levels should justified, then I think many investors pay attention to that aspect rather than incremental increase in profits in the near future when the dollar yen moves 2 yen or 3 yen. So, so for long-term investors, it is not time to buy all exporters' shares just because the yen is getting very cheap. But on the other hand, short-term players tend to look at the volatility in currency markets. So if you think that the yen might weaken further in the next few weeks, then it might be a good idea to buy Japanese car maker shares. So I mean, it really depends on the time frame of your investment, I think.
That was our senior Asia stock reporter Hideyuki Sano there, and sticking with that weaker yen theme and also the impact on earnings, because Nintendo is another company that's just reported, and it says it will soon announce a successor to its 7-year-old Switch gaming console after forecasting a bigger than expected profit decline. President Shuntaro Furukawa posted on X to say an announcement on the next hardware platform will be made in the coming year. That came after a warning that operating income will fall 24% in the current fiscal year. Walt Disney shares tumbled the most in 18 months after a tepid outlook for growth in streaming subscribers. It also says theme park visits are expected to moderate from peak post-COVID levels. Disney Plus announced more than 6 million subscribers in the second quarter, but sees no core growth this period, with profitability hit by expenses for cricket rights in India.
Definitely back on a growth trajectory. Not just China, but all of Asia represent growth opportunities for us, both in terms of the streaming service in select markets, as well as in terms of the parks and cruises business. So we do see good growth opportunities there. Europe and Latin America continue to be good growth opportunities. And make no mistake, North America, we're not done growing yet. We still think there are terrific opportunities here for us right at home.
Reddit shares jumped in extended trading after first quarter sales topped estimates, impressing investors with its first results as a public company. Revenue increased 48% in the period to $243 million. And the social network projects sales in the current quarter of up to $255 million, which was well ahead of the average analyst forecast. UOB's first quarter profit came in above estimates as gains in wealth and card fees cushioned a slight drop in lending income. Net income for Southeast Asia's third largest lender was $1.2 billion, down less than 1% from a year earlier. The bank maintained its outlook for lending and fee growth. UBS shares jumped as it returned to profit after 2 quarters of losses. Net income of $1.8 billion was 3 times what analysts had forecast. CEO Sergio Motti told us the bank is close to cementing the integration of Credit Suisse.
Very good progress on our integration plans, but also it was great to see a very strong return on to profitability, both on a reported basis, but also very strong underlying profits. We also see good momentum with clients, with inflows across our businesses, and our capital is strong, so allowing us to continue to pursue our capital return plans.
And also, the investment bank was actually quite strong, better than expected. Again, what does it tell you about what you can see in the future? Is it a one-off, or actually is the path ahead better?
Actually, it's a good momentum. You may remember in the fourth quarter, we also had a very strong performance in banking. As we integrate the new colleagues from Credit Suisse on our platform, we start to see the pipeline developing. We are able to execute. And so it's very much aligned with our expectations of improving the mix between our markets business and our banking business in the investment bank.
So in the investment bank, where do you see the biggest strength? I know we also heard about possible job losses in Asia. Is Asia at the moment weaker than, for example, parts in the US and investment bank?
No, I think that we reinforced our franchises globally. I think that, of course, we are still going through across the entire bank. We are still a lot of work to be done to restructure the businesses and to bring them back into even stronger profitability. So I think that is a good momentum. We achieved almost a 10% return on CET1, which is still a third or 50% away from our final target. So still work to be done. We always say that 2024 is an important year. And as we now approach the end of May, we're going to execute on our legal entity mergers, which allow us to unlock in the future further cost savings.
An important year, 2024, because it's also a more difficult year to 2023?
No, because it's a more, first of all, we have 2 huge milestones, the merger of our legal entities, and the second one, we start to do the migration of clients from the Credit Suisse platforms into the UBS platforms. So this is very technical, still requires a lot of support and people to do that. And but as we start to do that, we can unlock some cost savings, but also unlock capital savings, funding savings, and therefore achieving our final targets to achieve 13 billion of savings by the end of 2026. For this year, we do expect half of that being achieved, so 6.5 billion.
UBS CEO Sergio Motti there speaking to Francine Lacqua. More ahead on Daybreak Australia. This is Bloomberg.
Apple's unveiled a new AI-focused iPad Pro and a larger iPad Air, aiming to reinvigorate a tablet lineup that's languished over the past 2 years. The Pro revamp includes an OLED screen and faster M4 chip. Let's get analysis now with Kiranjit Kaur. She's Associate Research Director for Mobile Phones Research at IDC Asia Pacific. And Kiranjit, let's just start off with your reaction to this lineup that came out. Of course, we've seen weaker tablet sales. They've sort of picked up slightly in the first bit of this year. But do you expect to see this lineup help to stimulate further demand?
I think it should stimulate further demand and more growth in 2024. Apple didn't announce any iPads last year, so that led to a lull for Apple in the tablet segment. But with this announcement and 4 new iPads and a price drop for their iPad 10th generation, it should hopefully trigger some consumer interest. They should be looking to upgrade some of the devices that they had purchased earlier during the pandemic time.
And where do you see most of the demand coming from? Because as we said, there's been sort of that lower price tag segment, and then you've got the upper end where it's that sort of clear competition, perhaps where Apple's looking to compete for iPhone or AI PCs rather. Which one are you more excited about at this point in time?
So obviously the iPad Pro with the tandem OLED display and with the new M4 chip and with the more powerful neural engine. So that obviously, it is for the premium users and has the most upgrades that Apple has seen in the iPad. But again, I think because of the higher price, it's going to be focused on the pro users, more premium users. But most of the growth should come from iPad Air that is just announced. And at the same time, for people coming into the iPad camp or iOS camp, there is the lower priced iPad 10th generation that should be driving most of the volumes. But at the same time, the iPad Pro that clearly puts Apple in the space where we are talking about AI devices, whether it's laptops or iPads or any other portable devices that we're talking about today.
Interesting, we didn't sort of hear a whole lot about the AI strategy. Do you think that's what investors are really looking for? If they're saving that for June, is there a risk of under-delivering and disappointing there?
I think it was kind of expected that this event is more for the iPad rather than being focused on the AI strategy, because the AI strategy is not going to be just iPad focused. It's going to be encompassing all the other devices, the phones or the Macs or, the a whole range of Apple devices. So we should hopefully hear more about it in WWDC. Tim Cook has been hinting at it. But from this event, what we see is the clear focus on making the hardware capable to run some of those AI algorithms and, have the processing power, have the horsepower when Apple is ready to bring the software into it.
Kiranjit, how do you think this plays out in the key market of China, where obviously there's been a lot of challenges for Apple? Do you see a steady recovery there, or is it this sort of these levels are more of a new normal for Apple?
I think Apple should probably brace to the new normal, which means that maybe it wouldn't get back to the same levels that we've seen when Huawei was on the decline. But at the same time, Apple, the interest in AI and the newer features would generate interest, not just in China, but other markets as well.
Kiranjit, do you think that Apple needs to make markets or tweaks rather that are specific to markets and mainly China, of course, given it does appear to be losing a little bit of ground there?
The challenge for Apple in China market is the resurgence of Huawei to a large extent. So if you look back at 2019, when some of the trade bans came into place and then the pandemic happened and, people were all grappling to get their hands on the latest and the premium devices, it really helped Apple to grow in the China market then. And now, if you look at most of the Chinese vendors, they are bringing AI into their into the language when they are selling their products. So I think 2024 is the year when we'll see a lot of the Chinese players talk a lot more about AI in their devices, about different use cases, how they're differentiating in terms of different on-device generative AI applications. So I think it's the right moment if Apple announces something in WWDC next month, and then in fall this year when the new products, new iPhones launch, and if we can see some of those features differentiate iPhones from the Android players in the market, that should definitely help Apple to kind of claw back on some of its share in the market.
Do you think there needs to be any sort of concern around perhaps Apple losing ground to Chinese-made smartphones in other markets outside of China?
In the other markets, I think clearly Apple has had a dominant position in the premium segment. But what's more interesting to see is that even in the emerging markets, Apple is having a hold in the premium segment, but we are seeing more and more users moving towards the premium segment. So the overall pie is increasing for Apple. We've seen tremendous growth from Apple in markets like India, in Indonesia, in some countries in the Middle East. So there is definitely, I think, even though there is competition from the Chinese players, at the higher end, Apple is kind of in a safe situation. But yes, again, we've seen Samsung come up with their AI smartphone. So that's creating a lot of interest. Google has just announced their Pixel 8a. They've been talking a lot about AI in their smartphones, and their smartphones are known for AI. So in the premium space, I think what Apple needs to look at in the non-China markets is what's the overall messaging coming around AI. But in overall, I would think that, Apple is still kind of in a safe space there.
Kiran J. Kaur, Associate Research Director for Mobile Phones Research and IDC Asia Pacific. You can watch us live and see our past interviews in our interactive TV function, TV Go. You can also dive into any of the securities or the Bloomberg functions we talk about. Join in on the conversation as well. You can send us instant messages during our shows. This is for Bloomberg subscribers only. Do check it out. It's at TV Go. This is Bloomberg. All right, well, it's an interesting time given, of course, we know many households around the world are still battling with the cost of living crisis, this sort of highly uncertain time with record high interest rates across a lot of economies. So we've been taking a look in this Bloomberg story at the cities with the most millionaires and what changes, Belle, that we've seen across these major cities, right? We know these are cities like New York, like Hong Kong, like Sydney at play here as well. And when it comes to New York, the stats are quite interesting. 1 out of every 24 New York City residents is now a millionaire. So the number of people with that seven-figure net worth has jumped in Manhattan, also across the Bay Area, and also Singapore as well is the other one that saw a major boost. Interestingly, Hong Kong, London, Moscow, though, seeing declines. And you see Sydney there also in play as well.
Yeah, it really is that shifting dynamic. I mean, of course, Hong Kong stands out as one that has, as you said, seen that bit of wealth exodus coming through. Tokyo is another where we've seen a bit of a decline. But cities on the rise as well in this part of the world. Shenzhen, for instance, you've got cities across India, Ho Chi Minh City in Vietnam, Scottsdale, Arizona. All of these are actually seeing more millionaires coming in, or doubling at least in the past 10 years. Really driven by, of course, that boom in financial markets that we've seen concurrently. And actually, this is the most read story on the terminal over the past day or so. It's just banker bonuses. Of course, it's a close topic to many of our viewers, but some can actually really perhaps look ahead to pretty good pay packet toward the end of this year, because the earliest predictions are coming through for Wall Street bonuses this year, and rewards could be set to jump here. So if you're someone who underwrites debt, you could see your payout swell as much as 25%. Deals picking up, we've been tracking that. For bond traders, equity underwriters, incentives could rise as well by 20%. But Heidi, always a very perilous task as well to try and predict bonuses at the start of the year. The big question, of course, is what happens over the coming few months.
Yeah, and what's also interesting, of course, is how we've seen, you mentioned Shenzhen, but I'd imagine there's also lots of changes when it comes to major banking cities like Shanghai, right? We have heard more and more reports of, if not layoffs, but at least some sort of attempts to try and, through attrition, reduce headcount with some of the big Chinese brokerages as the business continues to come under pressure there. So some pretty interesting stats there, and I thought pretty interesting for New York as well, given we have been talking about this big, exodus for that city in favour of Florida. And of course, geopolitics always at play, and the big story that we're following is what happens with ByteDance and TikTok. We heard from the former US Treasury Secretary Steven Mnuchin. He's still interested in buying TikTok's US operations from ByteDance. He spoke with Wall Street Week anchor David Weston on the sidelines of the Milken Institute Global Conference in Beverly Hills.
Still very interested in buying it, and to the extent they want to sell it or spin it off, we very much want to pursue that. I support that Congress passed the bill and it's now been signed into law. I will say this has had just incredible, overwhelming support with Republicans and Democrats. This may be the only thing that everybody agrees on. The fact that it's on 160 million phones, I do think it's a security issue.
Does the deal still work if the algorithm doesn't come with TikTok?
Well, the Chinese government has been very clear that they won't give an export license on the algorithm, and I understand that. We have sensitive technology that we don't want to transfer to them, and they don't want to transfer this to the U.S. I've actually spoken to a lot of tech companies on working about rebuilding this. I do believe the algorithms could be rebuilt. So my plan, if we were to purchase it, would be to rebuild the technology under U.S. leadership, make sure that it's all disconnected from ByteDance going forward, and that it is very robust and secure.
That was the former US Treasury Secretary Steven Mnuchin speaking to Wall Street Week anchor David Weston. And geopolitics is one of the key themes that we track for market moves across this part of the world. Today, though, for futures setting up for the opens for Japan, Australia and South Korea, looking very, very subdued at this point of time. Not really expecting any moves, big moves in either direction, given that lack of uncertainty and movement on the Wall Street session. Intraday traders are just really split over the outlook for here. Stronger earnings, expectations for Fed rate cuts, but still at the same time, you've got sticker inflation and the prospect is what we stay higher for longer. One of the key stocks, though, we will be watching and could see a pop at the start of trade is one in Seoul. It's a trading debut for a ship repair firm today. HD Hyundai Marine Solution. It's raised nearly $550 million in its IPO. It's actually the biggest one we've seen going back to January 2022, and it really cements South Korea's position as the busiest, or one of the busiest venues for fundraising through equity sales this year. Stock, as I said, could see a pop at the start of trade.